this is John Kvale, and this is our summer newsletter review. And I generally have these are in a little bit longer formats, but I'll try and keep us moving. A couple of good subject matters here, and with things moving really quickly, even some of this information by the time it got back from our New York printer was a bit stale. So here we go. For those of you that are in listen-only mode or are new, we do this in a video, audio, podcast-like format. So if you're driving down the road, keep your hands on the wheel. Be safe. I always say that. Okay, so here we go. This is just for those of you that don't visit the website and look at this on your cell phone. Here is the actual newsletter. It's embedded in the post. You can go through each page. Clients, you get this in the mail. It's already in the mail. Some of you probably already have it in hand. This will post, today is Sunday the 28th. It'll post Monday the 29th, tomorrow. All right, let's get to it. This is a really, and I really am looking forward to giving some voice to some of these articles. Again, some of them have gotten a little bit stale for obvious reasons. So when I started writing this post, the Straits of Hormuz were still closed. So in the newsletter, the price of oil was up here. For those of you that are in listen-only mode, I'm on the graph, hovering over the graph, around $100 a barrel. It's since the spot price of crude and West Texas Intermediate has dropped down, I'm looking at into the low 70s, high 60s. This is, and I marked this, essentially this was an extremely one-sided, oil went through the roof, not unexpectedly given all the geopolitical circumstances. And then what happened was inflation peeled through the system. And I have more charts that go with it in the actual newsletter in the form of CPI, producer price index, consumer price index, PPC, lots of different inflationary reads. It also bled into interest rates. And I'm not going to discuss that here, but the biggest thing that's, number one, the biggest thing is it's happened quick. It pushed inflation into the economy. It's not going to go away. Even though the oil prices have gone down very quickly, it's not going to just go away immediately. There's going to be some lingering inflationary effects. However, the cool part about this is next year, when we start crossing these comparables, we're going to see consumer price index and the other inflation gauges drop like a rock. So we're going to have some very interesting, and I'm going to hit Kevin Warsh here in a few minutes, but we're going to have some very interesting comparables. Bottom line, quick oil price up, inflation into the economy, pushed interest rates up. We're past that. We're going into most likely a slowing now, and so we'll see interest rates go down, and we'll talk about what Kevin Warsh is going to do with that here in a second. Okay, moving on. This is a review, and I said that purposefully. Basically, after we finished our income tax season, where we help as many of you that are desired, and we reach out to some of you that we know are having issues, we reflect on what's going on. And it really keeps us in tune with all of the moves that we need to make during the year to optimize our taxes. And keep in mind, I just said optimize. So let's first start with what problems we saw. We saw 60-day rollover problems. We saw basis problems. And then we also have seen, if you had an amended return, a hard time getting the money back from the IRS. Boy, they want their money. But let's not. Generally, the IRS is pretty fair. We find them to be pretty fair in their doings. But they are backed up from amended returns that are owed a refund. And so just be knowing that. Okay, one other thing, this sounds crazy. We look for reasons not to pay taxes all the time. We don't want to write our income down too much. And I pulled this chart. This is from the basically the Tax Foundation. And the top, this chart, for those of you that are in listen-only mode, is the top income tax bracket. And I really thought it was cool because, I mean, some of these were 90%. Yes, there were a lot in the 60s and 70s. There were a lot of write-offs that were available. But the whole point is, relatively, income tax rates are not extremely high now. And it's okay to pay a little bit of taxes along the way if it's going to even it out. So the goal is not to pay too many taxes. We don't want to pay more taxes than we want. So only pay our fair share, but don't get our income written down to zero just so we don't have to pay any taxes. It sounds like a victory, but it cannot be if we're pushing stuff out that we would maybe have to pay later. Okay, enough talk about that. This is essentially, have we been spoiled? I had an experience where on a Friday, actually it was around when Warsh came out, and we'll talk about this here in a second, when Warsh came out and kind of scared the markets a little bit. It was on Friday, then Saturday, or late in the week, I got no questions from any of my contacts. And I just wanted to reiterate that the quick market move down and then back up, which is what we've had over and over and over, even this is during the lockdown time in April of 2000, was relatively fast. It's a 6-month move. We won't let our guards down. We have been spoiled. Thankfully, I'm happy to have been spoiled, but that's not always the way. Occasionally, markets throw a big hissy fit, and it lasts a lot longer, and it's a lot deeper. Don't let our guards down. Oh, this is kind of funny. So actually, we're not going to. I'll conclude on the Warsh comments here in a second, because it's going to be in the video that comes in for June review. But in this newsletter, I talk that my two closing talks are AI, artificial intelligence blackmail, and then the 401k mandatory Roth reminder. So Anthropic set up one of their models and gave it some information, and then told it was going to be cut off, and they wanted to see what it would do. Well, it tried to blackmail. So, and they've since fixed that. Just be careful what we give the AI bots and our LLMs. Just be really careful. The more we give it, the better it works for us, but also the more control it has. Roth reminder, our 401k essentially is that once we get over the $24,000 500, if we made $150,000 and we have a catch up, we have to have a mandatory Roth contribution. So double check your 401k if you're in that zone to see. Okay, back to the Warsh. I'll say a comment on this because I am going to talk about it in the June review, which is this will go Monday, and then the June review will go on Wednesday. I mentioned that on Friday's post. So Warsh is essentially, Kevin Warsh is the new FOMC chairman, and I'll be short on this, but he does want to lower rates. He's a pundit of lower rates, but he's also a pundit of a smaller balance sheet on the Federal Reserve. What does that mean? Less quantitative easing. I'm going to tease you with that. This is our summer newsletter. There is more in the newsletter than meets the eye here. For those of you that are in listen-only mode, we're scrolling all the way back up to the top. I thank you for your time, and we'll talk to you again soon.